Hello, good afternoon. You've tuned into MF Corner coming live from CNBC TV 18. I'm Vinnii Motiwala. Thank you so much for tuning in as always. Now, index funds. We've spoken about what are index funds. You all are very excited about it. And this is the new favorite that's become in the town. It's low cost, passive and promising market returns. But the question comes in that investors are asking now that how many is more than enough in terms of an index fund? While in October 2024, sometime you had seen that index fund reach those highs of around 7,900 crores in terms of index funds. And there was somewhere in Jan 2025, it was at 5,254 crores, the investment that came in for index funds. And this is according to the AMFI data. We've seen a bit of a tapering off coming in, but still, index fund is the flavor. Everyone is looking at passive investing. So how much is too much of index fund as well? What's the smart strategy to build an efficient clutter-free mutual fund portfolio? Let's decode all of this with Udayan Adhye, the founder of Udayan on Money. Udayan, thank you so much for joining in with us, and a very good afternoon to you. Udayan, this is a very pertinent question right now, that given that there is a growing variety of index funds, whether you say factor-based, sectoral, international, how should investors decide which type of these funds, index funds, is genuinely something that will add value to your portfolio?
Good afternoon, Vinnii, and all the viewers. Thank you so much for having me. Always wonderful to be back at CNBC. So I think the entire idea of index funds, right, is to simplify your investments, right? Because you don't want to try to look for a mutual fund manager or a mutual fund that has its own investment philosophy, or that is trying to do something different. The idea of index funds is to invest passively, as you said earlier, is to have a very hands-off approach. You're essentially investing in one entire category of stocks or one entire category of securities. So with all these different types of index funds that have come in, whether it's a sectoral index fund, whether it's factor-based index funds, that have complicated just the process of index fund investing. Having said all of that, right, for all practical purposes, anyone investing, no matter where they are in their life, no matter what their goals are, if you're investing for over, say, a 4 or 5 year period for an equity-oriented portfolio, just having pure index funds will help you achieve the various goals you have. They're multi-purpose, and very specifically, all you essentially need if you are a very hands-off investor is to have a Nifty 50 index fund. Just one index fund will help you, build that long-term wealth. But at the same time, sticking to only one fund, whether it's an index fund, whether it's an actively managed fund, is difficult, right? Because our human mind is always trying to look for something better. So in that case, a large cap index fund, a mid cap index fund, a small cap index fund will basically give you exposure to most of the activity, most of the returns that are happening in the stock market.
Okay. Udayan, what are the main risks also that come in of holding too many index funds? And how can investors assess this if their portfolio is over-diversified into this situation?
So one common sort of problem I see in most portfolio constructions that have index funds, and this is either with prospects or even with clients before we start working with them, is something very specific. And I'll give you a very straightforward example. So let's say someone is investing in 4 different types of funds, right? Now, there's always a very high chance that if they're only investing in index funds, that's going to be a Nifty 50 index fund. That's going to be a Nifty Next 50 index fund, maybe a Nifty 100 index fund, and a Nifty Large Mid Cap 250 index fund. Now, for anyone not well versed with index fund nomenclature, this can get complicated, but what it essentially means is the Nifty 50 is India's top 50 companies. Next 50 big companies after that. The Nifty 100, essentially the same 100 top companies, right? So you straight away start noticing that even though you're owning multiple index funds, even though you have multiple different types of funds, they're actually buying the same stocks. So you may think that you're diversifying. You may think that, okay, this is reducing the risk in our portfolio, but it's like, you're having 4 different glasses of water, but one is yellow colored, one is blue colored because some color has been added to it. But at the end of the day, all that you're having is still water, right? Even though you have 4 different glasses. So that's one mistake that I see happening all the time, where people think they have diversified, but actually they're just investing in the same stocks at the end of the day.
Okay. I know you did mention that, Nifty Index Fund, Nifty Mid Cap Fund also is something that you can look at. what is the right mix in terms of index funds that they could invest in terms of the right balance that one could have, simply put, as well as how much is too much? When does it become a bad investment also? So number that he could have, which type in terms of index funds? What is your suggestion there?
So I am index fund biased when it comes to the large cap category. So all your large cap exposure can essentially be through just index fund. So it could, let's say, be the Nifty 50 or the Nifty 100 index fund, right? Which gives you access to India's largest companies. Then when you get to the mid and small cap categories, I personally prefer having actively managed funds there. So when you're looking at a portfolio construction, ideally, I would say a 5 to 6 fund portfolio is going to be more than enough for you to access different parts of the market without investing in the same place. Because the moment you get to a number higher than that, you're going to end up owning the same stocks. So in that 5-6 fund portfolio, I would personally lean towards having 2 index funds specifically. One is the Nifty 50 or the Nifty 100, as I said. And the second could be a momentum index fund in the mid-cap space. Okay. So there's a momentum mid-cap index called the Nifty 150 mid-cap momentum 50 index, which essentially means that in the 150 mid-cap stocks that are available in India, the 50 with the highest momentum are a part of that fund. Now, the reason this mix sort of, according to me, makes sense, we construct portfolios for clients also using a similar-ish mix, is because the momentum style of investing is not readily available in many actively managed funds today. There are funds that follow it, but those are fewer in number than, let's say, quality, value, or growth style of investing. So by having this very strategic mid-cap momentum allocation through an index fund, by having a large cap index fund, I think that is more than enough when it comes to index fund investing.
Okay, and any thing that, there are a lot of options also, there are a lot of fund houses. So why should you pick up one over the other, right? Because it's mirroring the Nifty 50 or the Nifty mid cap or any sort of an index that you would pick up. So which one is the best one, and what is a checklist in terms of picking these 2 funds that you would say also?
So when it comes to index fund selection, honestly speaking, one index fund is not very different from the other. Yes, if you really drill down into the very absolute numbers, there will be a difference of about 0.1 to 0.2, 0.25% returns every year because of just how they are managed. But honestly speaking, just go with a good brand pedigree. So the names that you recognize, just go with an index fund offered by them. If you want to get very technical, right, then you want to look at the tracking error or the tracking difference, and then you want to look at the expense ratio of the funds. Because think about it this way, right? Let's say the index, let's say Nifty 50 has given 10% returns. But to manage the fund, the mutual fund house that is floating that index fund is going to charge you some money, right? They have to still run a business. So let's say that is, instead of now getting 10% after fees, you're getting 9.9%. And when the fund manager is trying to replicate what is happening in the Nifty 50, which is the idea of an index fund, there's going to be some error or there's some difference in the allocation that they're trying to match. So even that can eat into return. So that is, let's say, 0.1% once again. So while the index has returned 10%, right, your fund has returned 0.1% negative across 2 parameters. So the total return is going to be 9.8%. So again, this can get complicated. There's a wonderful website called Index Fund Insights. It's based on an open source GitHub repo. Check it out. It basically, you select an index and it tells you which are the lowest total expense ratio, what is the difference, what is the tracking difference, and what is the total expense it costs you in total.
Okay, thanks for that. Surely we'll look into the site, and viewers, you all can also look in to the site as well and get a better hand on what you're investing in and how you could go about it as well. But, Udayan, how should one actually, and is it possible that I could invest in different asset classes using index funds without causing some bit of an overlap in terms of different asset classes? Is it a possibility for an investor? And how should one go about it?
There is a possibility. Having said that, I personally lean towards actively managed fund for, say, a multi-asset allocation, primarily because these funds have been in existence for a very long time. Like 2 funds that come straight to my mind, and these are not recommendations, are the ICICI Prudential Multi-Asset Fund, for example, or the HDFC Multi-Asset Fund, right? Very old funds, big pedigree names. So I personally prefer having allocation into these other categories, personally through actively managed funds. there are very few index funds that are tracking different multi-asset categories, or there are very few ETFs that track this. So I just personally lean towards actively managed for all these categories.
Okay, actively managed obviously is better if you want to invest in different asset classes. There is an option, but actively managed would give you better returns as well. Udayan, what about how often actually am I supposed to review my passive portfolio as well? Or when you're holding these index funds, what is it in terms of a rebalancing, or how should one look at this situation?
So in terms of whether you should change your fund, with passive investing, the entire idea is you are investing in index funds because you don't want to keep changing your fund, right? Because you're investing in just one category. Or let's say when you invest in Nifty 50, you are investing in basically a large part of the entire Indian stock market, right? Because of the 50 largest companies being a part of the Nifty 50. So if it comes to changing index funds, I am not in favor of it. Because once you invest in an index fund, just stick through with it for as long as you're basically investing for that particular goal. The one reason you may want to review your portfolio when it has index fund is rebalancing, like you said. So rebalancing essentially means, let's say you start off with, let's keep it simple, 100 rupees you're investing, 50 rupees in the Nifty 50 and 50 rupees in the mid-cap index. That's the Nifty 150 mid-cap index. Now, over a 3-year period, the mid-cap space and the large-cap space would move at different paces, right? And let's say now, 3 years down the line, your portfolio has grown to 150 rupees. And now out of that, your original allocation was 50-50, right? But now let's say mid-cap has done better. So mid-cap now forms not 75 rupees, but now 90 rupees of your portfolio. So at that time, just from a mental sanity perspective, because we always like to book some profit as investors, it keeps us happy, it keeps us invested, which is the most important part. Then in that case, it makes sense to just book some of the profit from the mid-cap space and invest it in the large-cap space. This is also a wonderful habit because everything is cyclical in the market. So, and there's enough evidence out there to actually observe that at the end of every market cycle, right, let's say over a 7-8 year period, the returns of large, mid, and small caps, they actually converge, right? So if you're rebalancing, then at every stage, you are basically looking after some of your profit and you're buying into something that is not perhaps doing well. And because it's cyclical, it is likely to do well in the future as well.
Okay, surely. Udayan, we'll keep an eye out on that. But, just one word, if you're to round all of this up, what is the checklist that I should keep when I'm investing in passive investing, in index fund investing? What should I be doing there?
So I would give you 2 words. I feel I'll give you 2 points, rather 2 words you put me on the spot, Vinnii. So one is purely from a numbers perspective, we look at the tracking difference and the expense ratio if you're selecting an index fund. And secondly, see how it fits your portfolio. So if you're already investing in a large cap fund and you're investing in a Nifty 50 index fund, they're investing in the same place. So it doesn't matter. You're not diversifying. You're just using 2 funds to invest in the same place. So identify where your fund is actively managed fund is investing. The easiest way to do this is go to perplexity.ai and put in your fund name, right? Whatever that is. Let's say HDFC top 100 fund, and ask what investing style is it? Where is it investing? It will tell you exactly.
Okay. Okay, Udayan, thanks for that view coming in there. But on that note, viewers, we're going to slip into a very short break. And after the break, we'll talk about mutual fund growth in B30 as well as T30 cities. So stay tuned for that. Welcome back to MF Corner on CNBC TV 18. Now, mutual fund investments are experiencing a surge, largely mainly driven by investors in B30 cities, which are areas beyond the top 30 cities in India. These smaller cities are witnessing a faster adoption of mutual funds, especially equity-linked investments compared to larger T30 cities that we are seeing. Now, to know more about this, is this trend something that will sustain as well? We have the Choti SIP that is coming in. We'll be discussing all of this with Udayan as well. Udayan, thank you so much for staying on with us as well. And, since the last couple of years, the growth that one has seen coming in, especially for B30 cities, has been phenomenal in terms of the growth there. So this shows that investment community surely, is moving just beyond the major cities. Are there any new regions or states within which B30 cities are emerging as a significant contributor, especially in terms of mutual fund growth?
So B30 has seen a surge in the growth that is taking place, in how much they are now contributing, the rate at which their contributions to the Indian total AUM that is accumulating, it's just phenomenal. A few states that pop up are Telangana and Haryana. Then in terms of cities, you have Cochin that is also seeing a big surge. It's very exciting to see because when investment education translating into actual investments starts happening outside of the biggest centers in India, that is when you know that there's a big wave of just very good things happening in the entire investment space.
Okay, surely it's interesting, there's a big wave that is happening. So how has investor actually in passive funds evolved in these B30 cities? Have we seen that also coming in? Because that means that they're not just here for the short returns. They are looking for those long term as well. And what are the trends that you have seen?
So one very interesting trend that is observable in B30 cities is that almost 2/3 of investors are essentially investing in just one fund house and one scheme, which is very interesting because that kind of shows you a trend where they are putting in money, and it's also very equity heavy. There's very little money going into other categories, other asset classes. So that is again very interesting because as the market evolves more, you would see fund houses spread their sort of wings into smaller cities as well. And more awareness campaigns would happen, which in turn would drive perhaps even more investment, right? Even a higher quantum of investment, because still the average ticket size of a B30 investor compared to the top 30 cities is still lower. If I remember correctly, I think it's in fact less than half of it. So as the market evolves more, as more players get involved, as marketing budgets get diverted to all these places, I think that will just contribute to higher AUM. It's already very high. It's already faster than T30, but I think it's going to accelerate even more.
Are they, Udayan, looking more in terms of other kinds of funds like flexi cap or sectoral funds? Is that something piquing the investors' mind as well? Obviously, sectoral funds was a trend last year, at least in major cities, but I'm not very sure about B30. Was that the trend there as well, or are they picking up the trend now after it's already come into the major cities?
So earlier, Vinnii had shown a graph of how the money was flowing into passive funds or index funds, and it peaked in October, and then it sort of has been dipping, and it was very low in the past few months. Again, that is very reflective of what's happening in the B30 market, because at the end of the day, right, a B30 investor is going to think in a similar manner when it comes to growing their money. Is going to say they're going to think in the same manner as a T30 investor, and what I mean by that is what happened in October 2024, right? When the index fund, passive fund inflows peaked. That was the time when the Indian market was at its highest, right? It started dipping end of September, last week of September. So how the markets do in a way is very directly correlated with where the money is flowing. With sectoral funds, the markets were doing well. So fund houses were launching sectoral funds left, right, center, right? We saw sectors or categories that we hadn't heard of before, or we rarely would have had a fund there. But just when the markets do well, the categories that do well, that is where the money follows, because unfortunately, as investors, a lot of people have short-term memory. And that's one of the caveats, or I would say learnings that would obviously evolve as an investor gets more experienced. But usually the trend, what is doing well, what has done well in the past 1 year, that tends to attract the most inflows.
Okay. And, between B30, T30, where are we seeing higher AUM growth right now?
B30 by far. B30 by far. The annualized growth, I think, is over 40% over the past 4 to 5 years in the B30 category. So it's the fastest growing segment as from a geographical diversification perspective in India, from a geographical sort of allocation perspective, it's the fastest growing sector of investors.
Okay. And, do you think those smaller ticket SIPs, we do have the Choti SIP coming in, this is something that will further boost the growth that comes in from B30 as well as T30?
100%, 100%. So there are some platforms that today offer a 100 rupee SIP, though the minimum ticket size is still 500. There are talks of it coming down to 250. I think those are great moves, because if you think about it, right, a lot of investors, when they first start investing in equities, and when their parents, grandparents had never done that, or they're just about getting to it, these are people who want to first test the waters. And we already know the average ticket size of a T30 investor is, of a B30 investor, sorry, is lower than a T30 investor. Just having the minimum SIP formally to be reduced would just make a lot of sense. It would attract a lot more people because they want to try it out. Or perhaps their budget only allows them to invest a certain amount of money. So it helps them, again, get invested. Once they get invested, if the markets do well, they become happy, more money flows in.
Okay, and are you noticing a shift that has come in terms of risk appetite or investment strategies in B30 investors recently? Has it seen an improvement there?
So, like I said, right, about 2/3 of investors are basically investing with one fund house. That is one thing that is very stark. I think that would change as more players get involved and there's deeper penetration. So that is one difference. But apart from that, again, it's a human mentality, right? What does well, where the money goes. That's not a great investment strategy, like we know, but that's what ends up happening.
Okay, and demographic-wise, B30 investors, is there any insight on that front as well? The age group that is investing, are we seeing young and early investors also come in, or it's much more in terms of, senior investors who are much more experienced, or, age group of 40 plus is someone who's investing there?
A large part of the new wave of, or the new investors, the new SIP folios that are getting created, I think if I remember the number correctly, is between 50-60%, is of people under the age of 30 in the B30 space.
Okay.
Which again tells you a lot, right? If you just were to explore reasons, there are not many studies that have happened that have actually explored why this is happening. But if you were to venture a guess, right, deeper internet penetration, more digital platforms being available. When you looked at trends, one thing I missed out on telling you was the allocation to direct plans, that is without a mutual fund distributor or an intermediary. Even that is at, I think, 2/3 in the B30 space. So that just tells you that, people are downloading apps, the famous ones that we know, and they're investing directly through those. So I think, again, that's a trend that we are seeing across the industry, but I think it's much faster in the B30 space.
Okay, much faster. And overall SIP registrations are also improving, right? You mentioned, or is it just Choti SIP, or overall there's an improvement in terms of SIPs?
Overall SIP registrations have shot up, and it's not just a flash in the pan. It's not a one-year thing. It has happened consistently for the past 5 years, year on year, and I think it will only go higher because of two specific reasons. Firstly, starting April 1st, people have more money in hand, right? Because of the tax slabs increasing. Not just that, but people who were earlier on the old tax regime and were making tax saving investments, it could be countered because now they don't have to make that tax saving investment. But I think just the surge of how much money is available, some part of it at least would get invested. And secondly, as India grows, these tier 2 cities, tier 3 cities, they start evolving. We saw that happening in China during a big Chinese boom. Happens to every country when they make the next big leap. And I think we're just seeing that right now pan out in India as well.
Okay, Udayan, thank you so much for joining in with us, explaining us the trends that we're seeing in the B30 and T30 cities, as well as always talking about index funds in the previous segment as well. So thank you so much for joining in with us on the show today. And thank you so much for tuning in to Mutual Fund Corner, viewers. With that, we're absolutely out of time on this edition of the show. Don't go anywhere. Up next, your closing bell to take you through the last hour of trade.